The other thing, Russell, is there is an opportunity to take a mortgage, especially like if you have a mortgage, you're paying principal and interest payment. There are products out there that are like advanceable mortgages, for example, allow you to slice and dice a mortgage. So you can refinance, you have to refinance to do this. Refinance, convert a portion that is principal and interest into a line of credit. So that becomes an interest-only payment.
Hey, Dalia, how you doing? Welcome to the show today. How are things out in Ontario?
Okay, Russell, imagine a hurricane going around in the media and it's the rates and the qualification and the values. And I am here staying at the eye of the hurricane, being calm and telling everyone to stay calm. That's what's going on right now.
But Dalia, the world is ending, is it not?
Right. Well, that's what the headlines are saying. The world is ending. It's the doom and gloom. Everybody's going to lose their houses, and it is terrible. Yep. And that's what the media does. Yep. Takes things and magnifies things to make an interesting story. But
I'm going to do that on the title of this episode, is I'm going to put in "The world is ending, run for the hills." That'll be the title of this podcast. So everybody will click on it to at least watch, right?
That's right. That's right. That's exactly the point.
Dalia, well,
I am good. I'm very good.
Oh, good. Very good. So it was, for those of you, if you're following along on the podcast, Dalia was on episode 76. That was like 50 episodes ago, Dalia. It's been far too long.
Wow.
However, you've been a regular contributor with Dalia's financing tips that are out there. It breaks up the pattern of me just yammering away, and Dalia comes in there and does some wonderful financing tips, and you've had to pivot a few of the tips to keep it relevant with what's going on. And what I wanted to do here today was I wanted to kind of break that out into a little bit more of a deeper dive to help real estate investors navigate these turbulent waters. And you got two good captains at the ship here, steering the ship for you here today.
Yes, so, I love the captain philosophy. I go sailing, and there is a quote that says, I can't remember the quote exactly, but the idea is when the wind changes around you and the waters get rough, you have control over the direction of the sails. Yep. And that's going to keep you focused on your destination. And that's what we can do in this environment right now.
Absolutely. Couldn't have said that better myself. But before we do, I'm going to pull a cardinal sin here a little bit, as I'm going to date this one, and I'll bring this episode out pretty quick after recording. We're recording this on a Friday afternoon, late afternoon for you, before a long weekend too. So Dalia, we should be having like a glass of wine or something with us here.
My water.
Well, I've got.
But here's the vodka. The vodka is in this bottle.
Okay. That's that vodka is gonna be the thumbnail for this video, by the way.
Yeah. This is a good size vodka.
Nice. Well, I've got cranberry juice and organic lemon and squeeze some lemons in there. So I may have to dip into the vodka myself here shortly. Okay, well let's get after it here. Thank you very much for talking about, keep being a calm port in the storm and a calm, captain on the seas, or whatever analogy we want to use. We'll stick with the sailing theme as much as we can for this one. So, and guys, the reason I mentioned episode 76 is usually on a lot of episodes we talk about our backstories and things like that. Dalia did an amazing job talking about her backstory. So if you need to get some context about who Dalia is, go back, check out episode 76, and we go into a lot of detail. But we're just going to cut right to the chase here today. The interest rates went up recently, or I should say the prime lending rate has gone up, Dalia. What was the latest announcement from the Bank of Canada, and how is that impacting real estate investors right now?
So that was a bomb, literally. The July announcement was a bomb because everyone knew that the Bank of Canada is expected to raise the rates, but the expectations were at around 75 basis points, and the bank raised it by 1%. And they front-loaded, the terminology that they're using is that they front-loaded the rate increase, meaning that they had the intention to continue to increase, but they decided to load up the increase in this July announcement. So rates has been the going topic, Russell, and we know that the inflation is high, and the bank is trying to use this tool to slow things down, and they are coming at it aggressively, which is understood. And we're expecting more increases. So there is September coming up, and the expectations is that there is another 1.5% baked into the system that's going to kick in between now and early 2023. So this obviously has impacted some investors in several ways. One, there are investors that have seen their adjustable mortgage payment go up, and that, of course, impacted cash flow. Rates rising now has impacted mortgage qualification because, as you know, back in 2018, the stress test kicked in, and the lenders are using either the rate that they're approving you for plus 2% or the Bank of Canada at 5.25 to approve an application. And now this bar has, gotten here, and we're above the 5.25. So the qualification bar has come up, and qualification as a result has become tighter.
Yep.
So these are the two key impacts, I would say, from the rising rate environment. And this is why we've come up with several tools and strategies to help investors continue to qualify and also address any impact on cash flow or on their budgets.
Yep. Wow. Whew, you said a mouthful, and we're only 6 minutes in here. And I was asleep at the switch here. When you said dropped a bomb, I should have been dropping a bomb here. Right?
I was waiting for this. I was waiting for the explosion.
Well, we were all still in shock from what happened in July, right? And guys, here's the thing: is it happened. The bomb was dropped. Nobody really exploded. We all got on with our lives the next day. Everybody had like 10,000 social media posts bombarding your Facebook feed with all the kind of stuff, and life goes on, right? Has it impacted the mortgage business quite a bit? Has things just slowed down, or are people shifting? How has that impacted the mortgage business for you?
So it definitely slowed things a little bit because there are investors that I'm finding are sitting on the sideline, not wanting to do anything right now, and just listening to the fear out there. So there are investors who are in great positions right now to still line up equity in a way that makes sense, despite the fact that the rates are high, because the market ahead is going to present opportunities, and they've explicitly expressed interest in continued growth. And this is the market where you're picking up better deals, and there are no craziness around offers and above asking and all of that stuff that was happening 6 months ago. I'm finding that some investors are sitting on the sidelines, and of course that this has an impact on the mortgage business. But for those investors who are proactive, understand that the rates have gone up. Real estate is a numbers game. I'm still going to pick up properties, and if the numbers work, then I'm going to go ahead. These investors are still the movers and shakers in both the residential and commercial space, and they're still making things happen.
Yep. Well, and here's I had this conversation with somebody, and they were telling me, and I'll just use a fictitious example, but I'll be pretty close. Let's say a duplex in Hamilton that went up to like $1 million for a duplex. And somebody was sitting there going, "Oh, we just can't find any of them out there right now." Now, all of a sudden, that same duplex is now $800,000. And the same person is going, "Oh, I don't want to buy that," right? Because the interest rates are gone up and it's gone down in value. Like, it's so funny. It's like 6 months ago they would have paid $1 million. Today they won't pay $800,000. But some astute, savvy investors are just absolutely just snapping up a few of these things. Now, I'm by all means, I'm not telling anybody here to be cavalier and just go willy-nilly, run your numbers, run them tighter than ever before. And you have to factor in that interest rates are going to be probably running a little bit hot for the next little while. And you better get some good rents. Now, here's one thing that's happening very, very nicely. I guess nicely from landlords, not nicely from tenants, but our rents are going up like crazy right now. And in different markets, I saw, what was the report I saw in Toronto? In Toronto and area, it was like 21% year over year growth on rentals out there. So your rents are going up. I know the costs are going up, but some prices have come down. So you know what? It's very similar to what it was like 6 months, a year ago in buying properties.
Yeah, exactly.
Okay, so let's unpack the little bit. So the interest rate. So just for clarification, you and I eat and sleep and breathe this stuff all day. It was the prime interest rate that went up. Fixed interest rate did not change. Can you just give people a really quick definition difference between a prime rate, a fixed rate, and a variable rate?
Yeah, so a variable rate is tied to prime. Prime is controlled by the Bank of Canada. So when you hear your typical big bank saying, I'm going to give you a variable rate at prime minus 0.5 or prime minus 70, they're essentially pricing the mortgage based on what the Bank of Canada overnight rate is. So right now, prime is at 4.7. Every time Bank of Canada pumps up the overnight rate, prime goes up, and off prime, the banks price their variable rate mortgages, and they offer a discount off prime. This is why you hear prime minus half, prime minus 25. So every time the Bank of Canada changes the overnight rate, prime changes. And there is a key point here that I want to mention, Russell, about variable rate mortgages, because I think the terminology is misused.
Yep.
There is something called an adjustable rate mortgage, and there is something called a variable or a capped variable rate mortgage. Adjustable rate mortgage is a mortgage whereby the payment increases as prime increases. A variable or a capped variable is a product where the payment stays the same, although it's a variable rate, the payment stays the same, but as prime increases, the allocation of what goes towards principal versus interest changes. Meaning, if prime goes up, more payment beneath the surface goes towards interest and less goes towards principal. So that's a key point because not everyone knows this. Then fixed rates, of course, your payment stays the same, but the fixed rates pricing is determined by the bond yield. It's a different base for pricing altogether. So when the Bank of Canada raises prime, it doesn't mean that the fixed rates are going to change. The fixed rates are based on the bond yield.
Yep. Now, it just recently took a big drop just recently, did it not, within the last day or so?
Yes.
So, I know it's always one day or 1 week is never a trend or things like that, but there's a lot of banter around, oh, geez, honest to goodness, guys, if you ever want to get some anxiety, go jump on Twitter for a little while right now, especially if you follow real estate pundits and real estate people. Just jump on Twitter and you'll get some anxiety pretty quickly. There's people out there that are just absolutely giddy and cheering for all this kind of stuff to go. I don't get it. I don't understand it, but I guess back to my point. The bond rates have come down, have they not, recently?
Yes, they've come down, and there is an expectation that the fixed rates will come down a little bit. Right now, the differential between variable and fixed is about 200 points, meaning if you're in a variable rate today and you're looking to lock in at a 5 years fixed, it's going to cost an additional 2%, roughly. Yep. That is how big the gap is.
That's quite huge. That's larger than normal.
Huge. It's huge. And this is why, in my view, this is not a good time to lock into a 5 years fixed. And we can talk further about this. But the insurance you have to pay is huge. But back to your point, Russell, the bond yield has softened a little bit, and there is an expectation that the fixed rates as a result will follow eventually and come down slightly. Having said that, they're still going to be here compared to where the variable rate is.
Yeah. Yeah, and now I watched in depth the when the Bank of Canada announced governor and the housing minister were on and did their announcement, and I imagine you did too. Like that's how geeky we are. I have in my calendar Bank of Canada rate announcements.
I have it too. In red.
Yeah, exactly. So I sat there and I watched it, and I had a heart. No, I don't doubt some of the statistics they were sharing. I don't doubt it. And the one that kind of jumped out to me was they said that only about 10% of Canadians would be impacted by this that are in probably variable rate products. And I don't doubt that as their number. But I can almost guarantee 100% of everybody listening and watching this probably has some variable rate product in their portfolio, especially if they're a real estate investor, because it is the right tool to use for investment purposes. So even though the Bank of Canada was saying, well, I know only 10% of people it'll impact, 100% of investors are being impacted by this. So
a large percentage, agreed.
Yeah, but here's the thing. Some people I know that have free and clear houses and stuff like that, and everybody's just kind of, they're going, oh, what do you mean the interest rate changed? Right?
Yes.
So what we're going to do here is we're going to provide some practical solutions for everybody. So, okay, variable rate changed, fixed has not changed, but there's still such a huge premium right now, still cannot advise going for it. Are you seeing any changes to the discounts off of prime for variable rates right now, or are they still an anemic like 0.25% type things?
They're anemic right now.
Okay.
0.25. There are some discounts at 0.5 on rental properties. Primary residences are a little better, but yes, the word anemic is accurate.
Yep.
And the gap is still large between a 5 years variable and a 5 years fixed.
Yeah.
We're going to talk about the strategy, so I'll keep my comment until we get into the strategies.
But I have a feeling, and this is something I've made a prediction. At the end of the day, sometimes bottom lines of banks dictate some things as well. I have a feeling if mortgage business starts slowing down to a point that it's going to start impacting profit numbers and payouts and dividends to shareholders, you're going to start seeing a few banks getting a little more aggressive. Now, they can't change prime, but they can change discounts off prime.
They can, absolutely, to drive business, 100%.
Or you might start seeing...
And I've talked to folks in the industry, and there is a little bit of a slowdown. And to your point, that is a tool that the banks would use to drive business. How much discount are they offering to, attract new business through brokers or through the branch channel?
Yeah, and I remember I bought a good portion. I bought like 40 or 50 properties when prime was at 6. And at that time, the lowest discount off of prime you would get is like 0.75%. Many times it was like 1 or higher a lot of the time. So I think you're going to start seeing a lot of those things starting to come in. And I'm also on record of saying a prediction is I think we're going to start seeing extended amortizations again coming out. I could be wrong.
There is talk about it. Yes, there is talk about it.
But I have a feeling there will be some of these innovative products that will be coming out again right now. Like right now, it's just honestly the bomb has just dropped, and now everybody's just kind of picking up and going, well, what's the collateral damage and what does all this mean? Is it, and then the market is slowing down a little bit. Holy moly, the Canadian real estate market is a big driver of the Canadian economy. And they're now going to find out maybe how much of a driver it is. I have a feeling they swung too far with the pendulum one way. Let's put it this way. For too many years, it was too easy. Now it's too difficult. And I have a feeling it's going to probably settle somewhere between difficult of center.
Yeah, it always comes back to center, right? That's always the case.
Or tries to.
Or tries to. With respect to your comment, Russell, about the extended amortization, some alternative lenders are offering 40-year AMs.
Okay.
So that exists. And yes, there is an opportunity to offer it on a broader scale. It's not firm yet, but some lenders right now in the alternative B space offer a 40-year AM.
Good. So there are, let's put it this way, at the end of the day, as an innovative mortgage solution provider like you and your team at Streetwise, it's in your business that you have to come up with solutions for people. Or else you don't get, groceries don't get put on the table, if you will.
Well, this is we've been coming up with solutions to adapt and thrive in this market. And that's what I truly believe in. How do we think about things that we can control to help us manage change on the rate front, on the values front, on the qualification front?
Yep. So, and we're going to unpack each one of those. But if I was to just sit here, and I know you've kind of have touched on a lot of these, if you were to give your best synopsis on what your prediction is going to happen with rates over, let's take the balance of 2022 and then 2023. Let's just take those two things. What's your best crystal ball forecast? And I'm not going to hold it against. I'm not in a year's time. In a year's time, I'm not. In a year's time, I'm not going to play this clip again and say, "You said, Dalia."
Okay, so it's not really my prediction. It's not a surprise. Okay, everyone knows inflation is high. The Bank of Canada hates it. They're going aggressive at it, and they're right now the overnight rate is at either 2 or 2.5%. Forgive me, but they are close to the upper band of their overnight rate, and still inflation is high. It's not an immediate thing that we're going to see change, right? Like it takes time for inflation to come down once the rate tool is implemented. So we're expecting, it's expected that the Bank of Canada will continue to raise rates. There is about a 1.5% baked into the system right now that is going to kick in between now to end of 2022 to early 2023. How fast or slow they go at it is a function of how the numbers are playing out as they review the economic reports and inflation reports and the data. So 1.5% is very likely between now and early 2023. Now, history says once the banks have control over inflation, and that's going to take some time, maybe 18 months, we're going to sit at these rates for 18 months, then they start to re-stimulate the economy slowly. And re-stimulating the economy means that they will remove their foot off the pedal, and we're going to start to see some discounts come back again. So for those who are thinking about locking into a 5 years fixed now, there is a risk that when the rates start to go back down again, fast forward 18 months, maybe 24 months, you're going to lock in for another 3 years right here. So that's why it doesn't make sense, in my view, to get into a 5 years fixed now and lock in at a high premium. But not only that, lock in for an extended period where at some point, the rates were likely to go down once things stabilize.
Yeah. And I very rarely have ever locked in, but if I ever have, the times that I have has been when the premium has been next like 0.25 or less, the differential between fixed and variable. And the other thing is I've quite often have done, I recommend this to people, is take shorter term fix, meaning 2s and 4s, sometimes those odd year or I guess even years. Banks sometimes have surplus cashes and those different terms, and they give unique terms. But even if, think about this, for a 2-year term, usually within the last 6 months, you can start renegotiating it. So technically, it's only 18-month term, really, that you're locked in for that.
Yes, so a 1 or a 2 years fixed is an option. It is cheaper than locking into a 5 years fixed. That's one of the tools we talk about. If someone is really, really panicking and they cannot sleep at night, 1 or 2 years fixed, it's still going to help you hedge and gives you flexibility when you fast forward. So that's one of the tools.
Okay. So if I was to summarize your forecasting, your prediction is that the rates are going to continue up a little bit more because inflation is running hot. And then probably later next year, they're going to probably start cresting, coming back down, getting into a little bit more of, not rock bottom rates again, but a little bit more I guess, palatable would be a good term to use.
2024.
2024.
Not
Okay.
2023. Yeah, 2024 is likely when things will start to improve.
Yeah. Well, and I know we could talk all day long about the whole thing around inflation and stuff like that. And I'm going to make this next comment I'm going to make is sarcasm, because you have to sometimes tell people you're using sarcasm. One of the biggest component of inflation, as we all know, is energy and fuel costs and gas at the pump and the cost to get the groceries there. If we only knew a country, Dalia, that had the third largest energy reserves in the world, if we only knew a country, and even if we knew a government that has a pipeline, they even owned a pipeline, they could actually just turn some oil and gas on or something and get more supply in the market. I wonder if that would have an impact on inflation.
Well, commodities and gas and real estate are part of the GDP, but I also know that there are some supply chain issues, but of course, gas is a big component. So let's go and talk to someone to open up these pipelines, and get some flow going.
And that's somebody from Ontario saying that, and I will mark that down there too. So. All right. Okay. So I appreciate that. Thank you for sharing your prediction. Now, okay. With all that being said, everybody is sitting here listening. Okay. Got it, Russ. Understand that, Dalia. I understand all this. It is what it is. Now, what do we do about it? Okay. I'm sitting here, my portfolio, my property I owned 6 months ago that was generating $350, $400 a month in cash flow. Now, all of a sudden is that $50 cash flow. What are some proactive strategies we can do from a financing standpoint to help stabilize and maybe increase our cash flow?
There are several things, and I'm going to touch on each of those quickly, but there is more to each strategy. So the first one is simple. Can we extend the amortization? Is there room to extend the amortization? Of course, we're going to look at the rate increase. We're going to plan for the rate increase and run the numbers to see if we were to extend the amortization, can we now reduce the payment or at least keep it afloat, right? That's one way. The other way is to say, you know what? The payments have increased here. My cash flow has gone down, but maybe I have an expense somewhere else on my balance sheet, one or more expenses on my balance sheet where I'm making a big payment. At the end of the day, everything is coming out of our pocket, whether it's this pocket or this pocket. The financial picture is here. So this has gone up. Is there anything here on the balance sheet that I can clear out for you? It may be there is a $1,600, $1,700 car payment that has, a $20,000, $30,000 loan left on it. If I swap a secured line of credit and pay that off, your payment is going to be negligible, okay, on that car. Yes, we've used secured money to clear it, but at the end of the day, what's our objective here? Our objective is to manage your cash flow, right? That is the objective right now. So can we clear any expensive debt here with cheaper money to open up room to move you ahead or at least neutralize what's happening on the portfolio end? That's another idea.
Okay, so I'm sorry, I want to unpack one thing you said, because I think it is an absolutely golden idea, is the whole extended amortization. Now, this might be a term, it might be new for some people. Can you unpack that a little bit? Like, what does that mean? Like, so I'm sitting in a mortgage. Is it only at renewal time? Is it only can I do it during the middle portion? Let's say I have 19 years left on my mortgage. Can I go in and apply for a 35? Like, what exactly does extended amortization mean?
Great question. So if it's renewal time, some banks will allow you to restretch amortization to its original amortization at renewal time with no qualification, with no issues. You cannot do it midterm unless you refinance and restructure the mortgage and get a new mortgage at a longer amortization. You'll have to wait until renewal with some lenders.
Yeah. So essentially, just the term I use that made sense to me is just revert back to original amortizations. A lot of banks will let you do that. So for example, if you took something that had a 30-year amortization when you started, over the last, say, 3, 4, 5 years, because of interest rates were low, you paid off a whack of principal, and maybe there's only 19 years left on the amortization of that mortgage based upon the current payment schedule. You take that back to 30 years, and I think I ran a calculation, and it was something like almost $600 difference in the payment.
Yeah, it makes a big difference. In some cases, it makes a huge difference.
Right. Okay. Excellent. So guys, one of the top things to do is contact a mortgage professional, talk about your mortgage products, get a portfolio review. That's the one thing we definitely will encourage everybody to do. Now, Dalia, do you know anybody who offers these portfolio review things?
I'll have to get back to you on that.
Okay, good.
We do. Yes, that's what we pride ourselves for here at Street. We look holistically at the portfolio, and we're able to develop strategies at a portfolio level, not just today's transaction or the one property at hand. So we'd love to help.
No, perfect. And I know you do. And I know how giving and caring. And one thing, if you do see Andrew, tell him some of those graphs that he posted out on some perspective about the graphs that he showed about the interest rates and stuff like that was very, very refreshing to show for the perspective on over the course of I think it was 60 years where interest rate typically were, and here's where we are at. Like, guys, this guy isn't falling. So
yes, we and Andrew is great at that. We support a lot of things through data. We actually developed a page on our website called Adapt and Thrive to just post data, interviews with investors about how they're doing things differently. So it's a great resource for those who are looking for ideas about how to navigate this new environment.
Okay, no, perfect. Now, I'm sorry, I didn't mean to cut you off there when you were just getting into a role. I'll get you back and I'll reframe again. So guys, what we're doing right now is we're just talking about, for real estate investors, how can we optimize cash flow? Now, I just did some training for my community, my inner circle, my coaching clients, and identified the framework. I call it the ICE, the ICE framework. You got ice in your veins. I stands for income, C stands for cost, E stands for extend. So up income, down cost, extend amortization. Or affectionately in our community, we now call it the up, down, sideways plan.
Love it.
So we were talking about we're extending amortizations, and you were talking about a few other things on the cost side if you have something on the balance sheet. Maybe share another strategy with people here, what they can do from a standpoint of financing to help optimize some cash flow.
There are two more things that I'd love to share. One is if you are in an adjustable rate mortgage, meaning if the payment is going up as the prime rate changes and you know that you want to fix it without locking into a fixed rate, there is a product out there called a capped variable rate. As I mentioned earlier, the payment stays the same. The allocation of principal and interest changes beneath the surface. So that may be an option, which still gives you flexibility as an investor because it's a variable rate, but it does give you that certainty that your payment is not going to change. That's a product that I wanted to mention. The other thing, Russell, is there is an opportunity to take a mortgage, especially like if you have a mortgage, you're paying principal and interest payment. There are products out there that are like advanceable mortgages, for example, allow you to slice and dice a mortgage. So you can refinance, you have to refinance to do this. Refinance, convert a portion that is principal and interest into a line of credit. So that becomes an interest-only payment. And yes, it's an interest-only payment and you're only paying principal and interest here, but this is going to ease up the cash outflow because it's an interest-only payment. And then later on, when you're ready to convert it back to a mortgage, it's a matter of calling the bank or the branch and say, hey guys, I want this converted back to a mortgage, and it's part of the product feature. So it is an option it's restructuring the mortgage essentially to allow for an interest-only component versus a principal and interest component to ease up the cash outlay.
Ooh-wee. Hang on. It's getting hot in here. We're not just talking plus 30 degrees. And of course, another bomb getting dropped. And this is one of those good bombs, everybody. A good bomb, not a surprise bomb. So that's brilliant. And guys, I know Dalia is too modest to say this, but I'm going to say this. Don't attempt that on your own. Don't attempt to even go to your bank. Don't attempt to try to go to your bank mobile mortgage person to attempt to try to even explain what Dalia just described. Go see an expert. Go see Dalia. Go see someone on her team, or go to your investment mortgage professional and talk to them about those options, and maybe try your best to describe what Dalia just described, or just phone up Dalia because she knows what she's doing.
We're happy to support everyone during these times. And these are tactics that work, but you can't take all of these tools and implement them. Everybody's situation is different. And that's where sitting down and talking about your goals and your finances and your risk appetite is where the discussion needs to go to determine what's suitable.
Yep. Okay. So I didn't mean to cut you off there again, as you talked about that strategy about converting some adjustable rate payments into a fixed payment, or a fixed variable payment.
Yes.
What's the other, the capped? Oh, let me get that correct. It's capped, adjustable, capped.
The adjustable rate is where the payment fluctuates. Okay. A variable or a capped variable is where the payment stays the same and the allocation beneath the surface is, changes.
Capped variable. It's amazing how everybody for all these years synonymously would just say all variable rates are the same, right?
Yeah, there is that difference.
Yeah. Nice. Okay. So that was the first one. What was the second one you were going to share?
So these are all of the tools, Russell, related to dealing with the rate environment, really. How do you restructure things to open up room to absorb the coming increases? How do you consider some products that will give you certainty? How do you restructure certain things to maybe pay interest only temporarily and convert it later to paying down the debt? These are some of the tools to navigate and to manage the cash flow.
Nice. So you're like me sometimes, Dalia, and I have to get a bigger screen here. Sometimes when I talk and describe things,
yeah, I use my hands a
lot. I make the joke sometimes. My wife says, I go, yeah. We make the joke as if, could I talk with my hands tied behind my back? I don't think I could. I don't think I could.
I can't either.
Or especially if you're having dinner and, you're having a wonderful conversation with people and you start getting excited. And all of a sudden I've been known for salt shakers and things. And I start putting things around the table and I start describing things by laying out the pieces on the table.
Yes, I can relate to that.
Nice. Okay. So extended amortizations, converting debt products, paying out some higher payment, lease payments, or unsecured lines of credit to secure them. Maybe what other kind of things? If we were just kind of putting a big giant smorgasbord of opportunities here or ideas for people.
The other ideas and opportunities are really around mortgage qualification, not rates.
Good. Yep.
So I'd love to touch on that. So as mentioned, the qualification bar has gone up because the rates have gone up. And under the new stress test, this is what happens. They use the higher of the two numbers, Bank of Canada or the rate plus 2%. So qualification is getting tighter. And what does that mean? It means that you may qualify for less, or it means that you may have to inject a higher down payment that you weren't planning for, or it could mean a complete decline, or it could mean that the file now no longer qualifies with an A lender and you have to move to a B lender. And if you were with a B lender, it may move to a private lender. We don't want any of these things to happen. So what are the tools? There are two levers, is what I call them: debt management tools and income tools. I'd love to talk about the income tools first.
Actually. Yeah, please.
Income tools are about adding income to your application, because at the end of the day, folks, financing is a numbers game. So debt and income. So how can we add more income to your application? Simple tricks. Let's say you have a property that is rented or vacant, and it's rented, let's say it's rented below market rents. You have a tenant that's been there for a while, it's rented below market rents. Rents have increased now. And if I am to go out and get an appraiser's opinion of what it would rent for, most likely I am going to get an opinion that the rents are here versus what you're renting it for. So there are lenders on the street that will take that opinion on the application versus the lease agreement. And there are lenders on the street that will take that opinion even on a vacant property. Okay? So I am going to utilize this to the maximum to help the numbers on the file. Because if I can get added income to your application through that opinion of market rents, why not? That helps us improve the numbers and deal with the tighter qualifications. So that's one strategy. The other strategy is about, it really works for self-employed clients. If you're a self-employed client and you would have more leeway to pay yourself from the business. So we can sit down and have a discussion and say, okay, what are you trying to do in the next 12 months? And is there an opportunity to pay yourself more from the business in the form of dividends or in a T4 or a combination of the two? Because that, again, will help the numbers. If you don't have that as an option and you're salaried, is there someone who can come on board on the application as a guarantor or even a 1% owner of title, bringing income to the deal to help you jump over that, hill, things like that. So these are the income strategies.
Wow. I'm trying to write down. I'm trying to take all these notes.
I can talk forever. I can keep talking forever.
Dalia, I'm trying to keep all these notes.
Stop me.
No, please. So that was the income side. What was the second side? The second lever?
Yeah, the second lever are the debt management strategies. And in that bucket, we're talking about the big payments on your application. The lenders don't care about the size of the loans. They care about the monthly obligation on these loans. Simple example, investors go and get a Home Depot card to renovate. And there is a 6 months, let's say, grace period for not paying, for paying. The lender doesn't care that you're not paying anything for 6 months. The lender is going to take that balance and calculate a payment of 3% and assume that's what you're paying. So that's one example. Another example is a car loan or an RSP loan. It's got $5,000 or $10,000 left on it, but the monthly payment is big. So we have to look at things where we can clear out some of these payments and use cheaper money to clear them out. And by cheaper money, I mean secured line of credit money or maybe mortgage money to clear them out. Because at the end of the day, it's just swapping the debt. And in the eyes of the lenders, it helps improve the numbers. We, of course, have to say, where does it make sense to swap? What is the impact on your monthly budget? And customize the recommendation, really. But that's really a key point when it comes to debt management strategy. Because sometimes as investors, we say, but I'm not paying anything on this card. Why can't I get approved? It's because the lender will assume you're making a payment regardless.
Yeah, it's interesting as I know we're sharing these things and they're fantastic. But honest to goodness, they're simple, common, good financial stewardship that we should all be looking into. Now, I'm not advocating that you take and pay off really low interest debt. Like that's a good tool if you have a really good low interest on something. But if it's a big giant payment, if you have a lease payment on a BMW that's at $1,400 a month, and it's a small payout to buy it out, it might make sense to do that if it would help your next application.
Yes, there is. It's a teeter-totter. Sometimes it's, are we trying to save or are we trying to manage the payment and open up borrowing power? And we have to be conscious of these two things.
Yeah. Now, are you? I have a feeling you also might start finding, if the banks are getting tighter. I think you've already alluded to this, that there might be some other alternative lenders stepping out. And someone told me right now, the differential between B lenders and traditional A lenders, the gap is really small there between theirs now. And maybe instead of going to the orange, red, blue, green bank, you go to a B lender.
Purple.
Yeah, and the purple bank, you go to the purple bank, right? And it's a little bit, it's not that big of a difference.
Yes, the gap has shrunk. The rates are still higher, but it is a great alternative. You're right. It is a great alternative because the rules are a little bit more lenient, and especially for self-employed clients, where do you want to save? Do you want to save on your taxes or do you want to save on the rate? At the end of the day, it has to make sense at the big financial picture. But B lenders, fantastic for larger portfolios, for self-employed clients, and for deals that no longer fit the bank guidelines and have to move here now.
Yeah, absolutely. Okay, now before we jump into valuations, is there anything else that you wanted to share on the qualification side of things?
No, we've covered pretty much everything.
Okay, excellent. So then, how was that for a segue? That in the business, Dalia, that's called a segue, right? So.
Yes. Right.
So, what are you finding out for valuations? I imagine appraisers are being extremely conservative at the moment, and their valuations aren't coming in. What are you seeing on the street, and how can investors mitigate valuation risk right now?
So we're seeing softer valuations in some markets. I wouldn't say it's in all markets, but in some markets we're seeing softer valuations, and appraisers have, disclaimers in the reports to just protect the lender and make them aware that it's a shifting market essentially in their view. So what does this mean for investors? Well, a couple of things. One, I am still seeing properties with a lot of equity, despite the fact that the valuations are softer. Beauty about real estate is that value does not evaporate. We're not talking about stocks here where all of a sudden value is gone. Yeah, there is a softer valuation. Over the long run, real estate tends to correct, but there are properties with equity in them. And what I'd like to remind investors of is, if there is equity in a property, my philosophy is to set up secured line of credits and have them in your back pocket. So if you have an existing line of credit, increase it. If you have, if you don't have one, see what you qualify for to get one. Why? Because a line of credit gives you liquidity. A line of credit allows you to jump on opportunities. When COVID hit, Russell, and people were concerned about their jobs or wanted to pick up on opportunities, there was a rush to set up line of credits. So while values are holding, it is a tool that I suggest you consider and have it in your back pocket. It doesn't cost you anything every month, but allows you it's a launching pad to whatever you want to do, but it's also a hedging tool for cash flow or for, emergencies.
Yeah, it's the in case of emergency break glass fund.
Yes, exactly. So I wanted to mention that. Now, if you're buying properties these days, and deals are starting to make more sense now, given, that you're able to negotiate, given that the prices are lower, I would still put in an appraisal condition or a financing condition, because you do not want to be in a situation where you have paid and the value is not coming through for whatever reason, because you're going to have to top that up from your own pocket. 6 months ago, everybody's going firm offers and above asking. And while they are applying for the mortgage week by week, the value is going like this, is going up. I have in my neighborhood, someone bought a house here across the street. They did zero to it, no renovations, nothing. A month later, they're selling it for a higher premium and it's sold. Okay. So we were in a market that was going up while you're going through the mortgage application. Now we are in a flatter market in some areas, or a market that is softening in some markets. So protect yourself by putting in your appraisal condition. And then lastly, Russell, the folks who are trying to exit deals right now, folks who have started a renovation or took private money and they were looking to BRRRR the property, buy, renovate, refinance, rent, repeat, right? They were expecting to inject money into the deal and that the market is going to go up. They may have taken private money. And now some folks, and I'm seeing more of these deals, some folks are having a little bit of a challenge exiting these deals because the values have softened. Private money lenders are becoming a little bit tighter with respect to loan to values, or even their costs have gone up. So they may increase the rate at renewal. And then qualification has gotten tighter. My point is, let's rethink exit. Let's figure out exit. Let's figure out what is the backup plan. What do we do now? How do we actually maneuver? I don't want anybody to get discouraged. It is normal to experience challenges in whatever, in any, like in life, challenges. And now we're seeing some of these challenges. It's best to just sit down, figure out an alternative plan.
Yeah. And I share this with a lot of people is, guys, the market that we had for the last 2, 3, even 4 or 5 years, that's not normal. That is not a normal market. Markets, you should not be able to do what you just talked about with your neighbor of put something in, do nothing to it, added no value to it other than just closing on it and sitting on it and sell it for a significant profit. That is not normal. Okay. Now, so we're now getting back to normal where you shouldn't be able to pull out $100,000 after your BRRRR. You shouldn't be able to do that. You might be able to have to leave 10, 15 in. But here's what I tell people is just get back to those solid fundamentals. If you're BRRRRing a property or you're flipping a property, one of the fundamentals you must do from the very beginning is analyze the property. If you cannot sell it, can you rent it and can you hang on to the property if all heck broke loose? Okay. So many people got away from that fundamental of that plan B backup because they just got dollars in their eyes. I use the term they went to Vegas and they got equity drunk. And sometimes when you hit the snake eyes or whatever, I'm using a bad analogy because I don't know my gambling terminology. But if you lost on a hand, you went all in and you lost everything. Like that's not proper business, gang. The proper business is you analyze the property. Here's the numbers if I'm going to flip it or I'm going to BRRRR it. And if I can't get this, how much money am I prepared to leave in? Or can I rent it and wait for market conditions to change to get that price for me down the road?
Exactly. And that's exactly how one should look at a BRRRR deal. But there are investors that have taken private money with the intention and high leverage private money with the intention to flip. And the properties are sitting on the market longer in some cases, or they cannot refinance. So yep. It's not like the investors who have done the diligence obviously are not in that situation, but we're seeing some of these.
What advice would you give to somebody if they came to you with that scenario? Now, here's gang. I didn't want to get on my soapbox and nah. But I get it. I made that exact mistake. I really did. Multiple times. Now it is what it is. Somebody went out. They were going to do a flip. Yeah, the market has softened. The house is sitting there. They've had 2 reductions. They got the high juice private money on there and the terms coming up on that. Like, how would you help that person out if they came to you? And I imagine people have come to you with this scenario.
Yeah. So one of the things we look at is what else do they have in their portfolio, and can we extract money from somewhere else to clear as much debt as we can so we can make it affordable to carry the property with that restructured debt. Sometimes we have to do that and replace the existing private lender with maybe someone else at a smaller private loan. In the very, very, very worst case scenario, there are deals that require an equity play, require somebody to come to the deal as a JV partner, to step in as an equity partner and it cannot be all debt-oriented solutions.
Yep.
So we have had situations where we did tell the client after looking at the entire picture, hey, go out and find a JV partner who would come to the deal with this much money because this is going to allow you to do this. And then we're going to turn around, refinance it with the JV partner and clear this with this debt. Like we have to orchestrate an equity and a debt solution in some cases.
Yeah, brilliant. That's exactly very similar advice I offered to somebody who was in the exact same scenario. I said, step number one is you need to find somebody to qualify for a traditional lower interest debt from the private lender. That's step one. Step two is you need to find a way that you can maybe Airbnb, short-term rent, corporate rentals, executive rentals. You need to get as much rent as you can as possible without potentially locking into a long-term lease. And
yes, great point. Yes.
So let's say you do corporate rental or executive rental or an Airbnb. You try to maximize the rent you can, and you have flexibility that maybe next spring is a good opportunity to put it back on the market again, or maybe it's next fall or it's the spring after. But can you keep the boat going? And can the boat keep going down the ocean while the water's coming in over the sides?
Yes, I love the formula you mentioned earlier because you're tackling income and you're tackling the amortization and you're tackling the cost. So when in my commentary today, I've tackled amortization and I've tackled cost because it's debt. But I love your recent comment about renting it because you're tackling that top line. How can you work everything together to resolve situations like this?
Yeah, I don't take any credit for. I'm from Saskatchewan. We keep things simple. It's the up, down, sideways plan. Right?
Up, down, sideways.
Up, down, sideways. Up income, down costs, sideways with the extended other amortization.
I love it. I'm not going to forget this.
You can by all means, please feel free to use it. So
good.
Okay, so we've talked rates. We've talked maximizing cash flow. We've talked about qualification. We talked valuations. Is there anything else that you like to? Has anything surprised you that has come out of some of these recent rate hikes? Has anything surprised you? Something maybe you haven't seen before, or just something that's interesting going through this process?
No, I wouldn't say I'm surprised by anything.
That's a good answer, by the way. That's a good captain shouldn't be surprised by some waves and some changing weather.
The pendulum goes this way and comes this way, and like we've seen this in the mortgage industry, and we just adjust.
Yeah, one of the things that has surprised me, and I don't think I've shared this. It actually has surprised me is everybody in your gut probably knew that the low interest rate party had to end. Everybody knew that in their gut. Mm-hmm. And now everybody's surprised that it did end. Like, everybody, oh my goodness, it ended. The world is, in some cases, the world is falling. Gang, we knew it was coming. And, or you should have known it was coming. And you should have prepared yourself, right, for the time. So I'm not here to, admonish anybody. It's just, but I think what has surprised the majority is that it's gone up faster than most people have thought. And we could have argued and debate the point is the Bank of Canada, in my personal opinion, should have started doing this over a year ago with smaller jumps as opposed to a big giant shock.
Yeah, I would agree with that, Russell. You're right. I would agree with that. And the July one was a big surprise, relating to this point in particular. So
nice. Okay. Now, before we do sign off here, did you have anything else you'd like to add?
No, I think you asked me a question earlier and I said, we talked about this, we talked about that, we talked about this. What else should we talk about? I think we should talk about wine.
Yes. It's summer. What's the summer wine that you're thinking about?
No, I'm just kidding. I am not a big wine drinker. I drink all red wines, so I don't even know.
Yeah, I'm a white and red. I'm an equal opportunity lush from time to time.
Oh, I like that.
Okay, Dalia. So appreciate your time once again. I thank you very much for stepping up and providing the financing tips on a weekly basis on my podcast. You're doing an amazing job and giving back and pouring back into a community that's provided so much for you. If somebody's out there and they're just kind of listening to this and, and they're feeling, I usually use the term stuck, but maybe they're feeling that they don't want to look at these things. It's like almost like the ostrich, right? The head's buried in the sand and la, 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 everything is wonderful. What would you offer to somebody if they're just feeling that they don't even want to look at the scenario, or they're deflecting or distracting themselves with, summer and boating and golfing, and they're distracting themselves? What advice would you offer to somebody if they're just kind of just sitting there, not leaning into this?
It's not an easy topic to tackle sometimes, to tackle the things you hate doing or tackle the things that are bothering you. But the power comes from facing the issues and dealing with them. And the problems are not going to go away. The challenges are not going to go away. And you minimize the size of any issue by making time to deal with it versus avoiding it through distractions. So I do recognize what's happening right now in some cases is a topic. Like everybody's like, oh, I don't want to hear this. I don't want to deal with it. I'm just going to spend my summer, enjoy myself. But really, guys, this is important it's important. Enjoy yourself. I'm not saying don't. And I'm not suggesting you panic either. But this is the time to plan, refine, and adjust. And that's key to continuing to be on track with your goals and to navigate the new waters successfully.
Oh, wow. Hang on. Ooh-wee. Getting hot in here. Ooh-wee. And of course...
I've got a bird on my face now.
Let's get some nuclear explosion going on, too.
3 times fire, explosions going on.
I 100% echo. And I'm going to add one thing to that, which is just a dovetail off to what you just said, is it's okay to ask for help. If you don't be embarrassed about asking and reaching out to people, professionals, it's actually you're doing them a disservice by not asking somebody, a professional, for help. Because how would you feel if you knew somebody that was struggling and they didn't come to you and ask for help? You'd be a little bit, geez, why didn't you ask me? I could have helped you, right? Yes. So don't be embarrassed. Yes. Reach out, ask for help, embrace your professionals, embrace your coaches, embrace your mentors, embrace the mortgage professionals and your that you've heard on the podcast. And it is not a sign of weakness that you need some help.
Absolutely. Yep. Ask. We are here to help. We are here to support. We're here to share. And we're all in the same boat. Yep. And that's what we do. Together, yep. We move forward.
Well, with that being said,
you're trying to row the boat on your own, yeah. And it's wavy. It's you're going to be standing still, or the boat is going to flip. I don't know, but if it's a group together and we all know what we're doing, and we're communicating, and we're sharing, and we're planning, and we're rowing in the same direction, we're all going to make it to our destination safely and land on a beautiful island and start drinking.
Gang, we're as real estate investors, this community is small and we need to stick together. It's not competition, it's collaboration. Now, where would be the best place for somebody to get a hold of you, Dalia, if somebody wanted to reach out and have a conversation?
info@streetwisemortgages.com is the email where you can get hold of myself and my team, or our website, streetwisemortgages.com, through the contact us page, which is front page.
Perfect. It's nice and simple. info@streetwisemortgages.ca.com.
.com.
Nice. You got the .com. Well done. Okay, gang, why don't we leave it there? More to follow. We're just leaning into more content like this to help you navigate the waters ahead. I might actually just maybe get a captain's hat or something to help with the glare that's coming off of all these studio lights and stuff like that too. So Dalia, as always,
you would look great in a captain's hat.
Okay, well, thank you. It's always an honor and a privilege to catch up with you, and I'm hoping one of these days we can actually do it in real person, and we can actually do one of those things that called hugs, right?
Yes, Russell. I would love to. Thank you very much for the opportunity to be here today and to share. I'd like to remind everybody that is listening to the media not to panic and not to have an anxiety. Be calm, talk to your advisors, plan, and this is a time that whatever is going to pass, we just have to plan and tweak and adapt. And if you need resources, go to our Adapt and Thrive page to stay tuned for what we're posting in the coming weeks in terms of tips and strategies.
Absolutely brilliant. Thank you again, Dalia. Okay, everybody, have a wonderful day. Well, I sure hope you enjoyed that video. 2 simple things to do from here. If you're interested in continuing your journey, interested in continuing to become a successful real estate investor, just below where you're watching this, there will be an opportunity for you to subscribe. And if you're interested in continuing your journey, there is a hand-selected video over here for you. It's been hand-selected for you to keep your journey going forward. Thank you very much.